What's up, guys? Bang, bang. Today's episode is a little bit unique. I have Phil Rosen, the co-founder of Opening Bell News. He is here today, and what he is going to do is interview me. That's right. I'm in the hot seat. He's going to ask me a bunch of questions about Bitcoin, President Trump's recent support of the industry, interest rates, and the financial media. I did my best to cram a ton of information and insights into about a 20-minute interview. We're going to try out this format. If you like it, please let us know in the comments. We'll do more of them. Maybe we'll try to do one a week where Phil interviews me. Only though if you guys like it. So make sure that you leave that comment, make sure that you engage with the video or the audio so that we know that we should continue doing this. All right, here is my conversation, or where Phil is interviewing me today.
Pomp, how are you doing?
I'm doing fantastic.
It's an honor to be here, and I'm excited to hear about your views on interest rates, Trump, and Bitcoin, as always.
Of course, I'm excited for you to do this and also everyone to meet you.
Yeah, let's do it. So I read your newsletter this morning, and you were writing about Trump's new position on Bitcoin. He's quite supportive of it. And can you explain a bit more about how you think that could impact the regulatory outlook for, even if Trump or Biden wins, they both seem optimistic. Can you talk about what that means for the regulatory landscape?
Yeah, if you think leadership matters, right? And so in every organization, both government and in the private sector, the leader sets the tone, the leader sets the, kind of positions, the leader sets in motion what everyone else is going to do. And so currently, President Biden and the administration, they've been very anti-crypto. They've been very anti-Bitcoin, anti-mining, just go down the line. And so what happens is everyone in the government apparatus is anti-Bitcoin, anti-crypto, anti-mining. With Trump, he was anti-Bitcoin. He has many tweets that he's put out there. Many times he said, hey, I actually don't like this. I'm very pro-America. That was his big stance, was Bitcoin is competitive with the US dollar. I do not want this happening. What I think has happened is people have started to educate him. I know that his sons have started to become more sympathetic to Bitcoin. They've started to understand it better across government, financial institutions, private sector, et cetera. A lot of people that I know that are wealthy or successful, their kids are the ones who kind of explained to them what Bitcoin is or what crypto was and why it was important. So I think that's a natural progression for Trump to go through. On one hand, there's people who now are saying, wait a minute, this guy was against it. Now he's saying he's for it. Is he pandering? Is he just going to and trying to get votes? There could be an element of that, right? I don't think he's stupid. I think he's hearing what the people are saying. And he says, hey, you guys want me to be pro-Bitcoin? You're going to vote for me? I'm pro-Bitcoin, right? At the same time, I think he's just getting educated. He's learning about this stuff. And I know many, many people, we could rattle off a whole plethora of folks from inside the industry that have gone and met with him, had dinner, been to different events with him, and really spent the time to educate him on this stuff. And so this is kind of like what Bitcoiners or kind of the crypto communities we talked about for a long time, right? Is the game theory is that they're going to have to support it. And so critics have always cracked me up. They're like, I'm smart. Here's my academic theory as to why the government is going to ban Bitcoin. And you're like, dude, you live on a different planet. What are you talking about, right? And the reason why the government has to support it is the same reason why the individual supports it, which is Bitcoin solves a real problem. Crypto solves a real problem. I'll give you a couple examples. If I want to protect the economic purchasing power of myself as an individual, Bitcoin does that better than any other asset in the world. If I bought gold 5 years ago before the pandemic and I held till today, I've lost purchasing power. Gold has not kept up with the decline of the US dollar. Bitcoin is the only asset that I'm aware of that is an asset class to itself, which has outperformed inflation. And so when you look at it from that perspective, it solved the problem for the individual around protecting purchasing power. If you go to more of a system approach, Bitcoin mining is solving a ton of energy problems in America. And people are like, what are you talking about? I heard that this consumes a lot of energy. Well, one, Bitcoin mining is over 50%, close to 60% of all energy consumed with Bitcoin mining is renewable energy. So what you get there is Bitcoin mining is probably the furthest penetration of renewable energy usage out of any industry in America. And so if that is the case, then actually we should be putting that industry on a pedestal, saying like, why is the rest of the American economy only 20% renewable? Why is it not 60? Right? Bitcoin mining is leading from the front in terms of that energy mix. And then you look at things like stranded gas. So gas flaring being a great example. If we are going to pollute the environment and flare gas, and we're going to burn a hole in the atmosphere, well, what if we could stop doing that? That'd probably be a pretty powerful thing. And that's exactly what Bitcoin miners are doing. They're going and they're stopping gas flaring, they're capturing that energy, they're mining on site. And so you solve that problem. And then you look and say, okay, well, that's Bitcoin and Bitcoin mining. What about stable coins? Stablecoins now collectively are the 16th largest holder of US treasuries globally. Well, at a time where China and Japan are not buying as many treasuries as they used to be 22% of all global debt, now it's down to 7%. Here come the stablecoin issuers. They're saying, we're going to buy debt. And so if you look at Bitcoin mining, crypto, et cetera, like we are solving real problems here. And so what I wrote in the letter was I said, look, it seems like technology has been solving real problems and critics have been crying, right? They're having this war of words, but technologists are having a war of action. And by solving problems, you're on the right side of history and you end up actually winning. And so naturally, politicians realize, wait a second, I'm not going to be the anti-progress candidate. I'm not going to be the anti-success candidate. And by Trump making that move, now all of a sudden Biden, he's backed in a corner. What do? Are you really going to cede the Bitcoin and crypto point to Trump? Are you going to let him take 50 million voters out from underneath you because they all are going to vote with their wallets? No, you're going to become more sympathetic to it. And so regardless of whether you believe either one of them, everyone is moving to become more pro-crypto and pro-Bitcoin. And that is very good tailwind for the whole industry.
So something I was thinking about when I was reading your letter this morning, presidents on the campaign trail make promises all the time, and they say a lot of things that don't end up being true. So in that sense, as far as what Trump is saying now about being super pro Bitcoin, what if he doesn't follow through on all of that? Is there a worst case scenario you see for crypto as an asset class, but also Bitcoin specifically? Yeah,
there's probably 3 different outcomes, right? There's like, okay, they say that they're supporting it. They get in office, they do support it. They go and they, deregulate some of the industry. They go ahead and make a bunch of actions that are very pro crypto. It's a boom for the industry and we're off to the races. That'd be great, but maybe it happens, maybe it doesn't. The other example would be that they come out and they say, hey, we're going to support this thing going into the election. They get elected, whoever it is, and then they do nothing. Again, promises not kept. That's like basically the name of the game for most politicians. So it's probably not a divergence from the norm, but they're not really doing harm as much as like they had an opportunity to do something positive and they didn't do it. The third, which is probably the most unlikely, is to come out in support of the assets end of the industry, get in office, and then 180 and then go attack the industry. There's very few examples in history of politicians going in, promising one thing, and then basically turning their back on that industry and going and hurting that industry intentionally. Of course, there's always unintentional consequences, and all the caveats. But my guess is we get one of the first two, regardless of whether it's Trump or Biden, is either they're kind of like agnostic to it, like, whatever, I got some votes for it, but like, I'm not really going to do anything, or they end up being supportive. It is very hard today to see a world where either one of the political candidates would end up being anti-crypto, because you have now other politicians in Congress and Senate that hold the assets. You now have people around them in their staff that holds these assets. And it's such a big voter base that you really got to kind of pay attention and make sure that you're not upsetting those people.
I think that makes a lot of sense. So something I've been wanting to ask you about for a while now is your view on interest rates, because that is the hottest topic in financial markets. We started the year with about 6 rates forecasted for markets, and now it's down to about 1 or 2. Where do you fall on that? And also, how has that impacted your view on how you're allocating investments and what you're considering? And also, are these conversations you're having with other investors changing because of the interest rate landscape?
Yeah, it's a good question. I would say there's 2 main points here. One, it is arrogant for the central bank to believe that they can set an interest rate. And when I say that, people are like, what do you mean? I'm like, the market is the true setter of interest rates, right? What is the cost of capital? The market determines that. When somebody outside of the market, in terms of the market force, an individual or an organization steps and says, no, we are going to set an artificial price of capital, cost of capital. That is an arrogant view. You are saying that you are smarter than the market. I just don't believe that's possible. So at the outset, setting the interest rate, I think, is a fool's errand, because you can't be right. You're not the market. You're not going to be able to self-correct. You're not going to be able to react to all the different economic factors. And so what ends up happening is you're trying to take all this data, which is backwards looking. You're going to use that backwards looking data to make decisions today about what you think is going to happen in the future. It's an impossible decision for any human to make. Now, put that aside. Say, that all sounds great, but they're still going to set the interest rate. I tend to be what I call a market observer, right? I'm not going to pontificate on what they should do. I just simply want to understand what are they going to do. What they should do is completely different, because what they really should do is not have the interest rate. And even if they have an interest rate, then they should probably stop this like volatile management of it. But what are they going to do? At the start of the year, it was pretty obvious to a lot of people, hey, they're going to cut. But what changed was they got a bunch of economic data that said, wait a second, maybe we shouldn't cut. And so one of the things that investors tend to do that I talk with is they get very rigid in their thinking around interest rates. They say, okay, well, interest rates are 5.5%. They're going to cut 7 times this year, 6 times, 5 times, 3 times, whatever. And they go into the year. By March, 90 days, it was obvious they were not going to cut 7 times, right? Or 6 times. And so when you look at that, you have to ask yourself, are you willing to change your mind? How quickly can you update your line of thinking? And so just like when you're building a product, you want to have very high iteration speed. In investing, you want a very high iteration speed in your thought process of what's going to happen. And that is all based on how much information can you consume, right? How can you sift through what is high signal, what's not, and then be able to act. And so as of right now, you could pretty much count me as somebody who believes the prediction markets. 1 to 2 cuts. Somehow they'll do a cut before the election. Central bank's supposed to be independent. Somehow we're going to get the cut before the election. I actually don't think it's going to matter that much. Right now we're at 5.5%, interest rates 5.75%, and you have QQQ all-time highs, right? You have S&P ripping. You have Bitcoin near all-time highs. With high interest rates, you're supposed to have asset prices crashing. What's going on, right? I saw a study recently that showed it is better to buy the stock index. They measured the S&P. It's better to buy it at the all-time high than any other day because momentum is real. So when it hits a new all-time high, right? The last time it hit a new all-time high, if you would have bought it, it kept going up and it hit a new all-time high, right? And then the further you go out, the more likely it is that it appreciated. So if you measure 3, 6 months, 1 year, 2 years, 3 years, 3 years is actually the biggest gap. So if you buy at an all-time high and then you wait a period of time, it's more likely that the asset has continued to go up. And so like that kind of is counterintuitive. But then also I've seen some statistics that show the housing market during times of recession doesn't really crash as much as people think. And so if you look at these things, you're like, wait a second, the investment class in terms of the citizens, they're going to be just fine. Recession, not recession, high interest rates, low interest rates, like people are getting rich. Stock market's at all-time highs. What are you talking about? The interest rate doesn't matter to them. Where interest rate really, really matters is the people who don't have investments, right? Because the investments are actually immunizing people from inflation and interest rates. But the people who just hold cash are getting decimated right now. There's estimates out there that inflation over the last 4 years has been somewhere close to 40%. Right? There's been a 40% expansion in the money supply. So if you look at that, you say, wait a second, you mean to tell me that if I had $1 at the beginning of 2020, today I got 60 cents worth of purchasing power? That is catastrophic to somebody's financial situation. And so I tend to think that the interest rate will come down. It'll probably come down a little bit this year and into the following years because on a macro basis, they have to. They're addicted to cheap money, right? And central bankers, they can fight things for a short period of time, but the system is stronger. It swallows them up. And I think that we'll end up back, somewhere in kind of the 2%, 2.5%, 1.5% range with interest rates over the next maybe 2-3 years.
It sounds like you take quite a long-term view on things, especially with what you're saying with interest rates. Do you think it's maybe wiser for stock market investors, even crypto investors, to be pretty agnostic about interest rates? Because unless you're day trading, maybe it doesn't matter that much.
Today's episode is brought to you by CrossFi. CrossFi is the Apple Pay for crypto. For the first time in history, anyone with a Web3 wallet like MetaMask can spend crypto through a physical or virtual Visa card anywhere in the world where Visa is accepted. No more exchanges or middlemen. Just link your wallet, get your card, and start spending today. CrossFi card transactions have already been successfully processed in New York, Los Angeles, London, Dubai, China, Japan, and over 20 other countries. Be one of the first to get your hands on a CrossFi card and a prize pool of up to $3 million by joining and participating in their testnet today. You can go to xfi.foundation/users. Again, that's xfi.foundation/users. Go check it out today.
I think interest rates are important around turns in the market, but they're not important during continuations of the trend. What I mean by that is if you go back to November of 2021, something that I didn't get completely right. I wish that I had paid attention more. For those that don't know, in November of 2021, I wrote a letter to outside investors. I said, hey, I'm having a kid. I want to go spend time, doing other stuff. I'm going to return all the outside capital. Part of it was like, I felt like it's like, how do I make money in this environment, right? Every time I go to look at a private company, the starting valuation is 50, 60, $70 million. It's just the math doesn't work, right? So I returned all the outside capital. Now, in hindsight, you're like, wow, literally the month of the top of the market, you gave back the outside capital. You're smart. Well, if I was actually smart, I would have sold all of the assets too. Right. But I didn't do that. So I can't claim that I knew it was top of the market, but I at least felt one part of it, which is, hey, this is getting too hard. Right. Now, why is that important? There are investors. Keith Roboy is a great example. On Twitter, he said, I'm calling the top. And a reporter tweeted at him and said, are you calling explicitly, are you calling the top? And he just responded, yes. He was off by like 12 hours. Wow. Right. Now, how did he do that? If you go and you ask him, he says, because the second they started talking about raising interest rates with seriousness, not like, oh, maybe we should do it like we're going to raise the interest rate. He knew from back in the 2000 tech bubble, when they started to raise the cost of capital, here come the assets they turn over. And so that's exactly what happened is cost of capital went up. They wanted to, quote unquote, destroy demand was the phrase they kept using. They did a fantastic job of destroying investment demand, but not consumer demand. And where we ended up was a world where we went from cheap money to expensive money. Market turns over and we go down. Now, again, that inflection point, that change in the market, interest rates really mattered. Now, did it actually matter when we went from 0 to 5.75%? No, because guess what? Asset prices went down. They came flying right back. And so it's only around the changes that really matter. And you can almost think of it like a regime. We went from a cheap money cut rate regime, right? We went down to 0% with 2 emergency rate cuts in 2020 and kept it suppressed there. But the second that they reversed and they said, hey, we're going to go back the other way. Now we're going to go up. That it matters. And so right now, whether they go from 5.5, 5.75 to 6, 6.25, it doesn't matter, right? What's going to matter is the first time they cut. Yep. And we're already seeing the ECB and a couple others start to cut. And so it's coming. It's just a matter of, is it this next meeting, the meeting after? It's going to be a 25 basis point cut most likely, but that change is where you got to start paying attention.
So how have your conversations from a year ago and maybe conversations today changed around how other investors are positioning?
I think that most investors are pretty risk averse. When you're investing, you have two things. You have to mitigate downside and you got to optimize for upside. And most investors in crypto, how good can it go if it goes well, right? But most other industries, people want to, hey, how do I diversify? How do I protect? How do I, really make sure that I've got that risk mitigation going? And what ends up happening is they're slow to move around those turns, right? Nobody wants to catch the falling knife. But if you go and you actually look at the best investors, they're willing to make those decisions and make those calls at the right time. One of my favorite investing kind of approaches maybe is Stanley Druckenmiller said that one of the lessons he learned from George Soros was buy first, research later, which sounds like GameStop or meme coins or like undisciplined investing. But his point is when you see a data point that tells you something, you should actually go get exposure to it, quickly do your research, and then you can always cut it, right? And yeah, sure, maybe take a little bit of a loss, but what if you're correct and it runs? The thing that counts is not how many times you're right, it's how much money you make when you're right, which is pretty important. And so if you go and you take a look at it, recently, for example, Stanley Druckenmiller said that he was watching a speech from Javier Milei, who's down in Argentina. He listened to the speech, he goes, oh my God, this guy is incredible. He's going to turn this country around. And he went on Perplexity, the AI search engine, and he basically typed in, he goes, what are the 5 most liquid ADRs for Argentina? 5 tickers came up and he bought them. And they said, okay, I'm going to go do some research now. Right? That is so counter to how many people invest. What most people want to do is they want to go look at all this data and they want to make sure. And it's like, okay, are they actually going to cut rates? I'm going to wait till they cut rates, all this stuff. If you waited till they cut rates, you've missed the entire recovery of the stock market, including new all-time highs. And so you have 2 things that you can do. If you're a young person, you have a long time horizon, get invested, stay invested, and shut up and just let the market do its thing. It's going to go up, it's going to go down, but over a long period of time, they're going to debase the currency, you're going to make money. The only other thing that you can do is if you are going to try to tactically change long versus cash or long and short, et cetera, is you have to be willing to risk mitigate with position sizing. And then you also have to be willing to make calls or make decisions on little information, but understanding, hey, we're going through a regime change. And so when I talk to other investors, frankly, most of them are lagging in performance because they aren't willing to make the big bold bets, right? We live in a world where Citadel and many of these firms, they're gathering assets. Why are they gathering assets? Their goal is not to make more return than the market. Citadel wants to make like 10 to 12%, market neutral, as little volatility as possible, and just keep 10 to 12%, 10 to 12%, 10 to 12%. But if you think of the great macro investors over time, what they want to do, they want to make 60%, 70%, 100%, right? It's just two different styles of investing.
So all of that said, I think the financial press is usually behind the ball on this stuff. We are reactive to market news and how investors are responding. Where do you see the financial media falling short in their coverage as far as how investors are positioning and how these interest rates are changing the environment for investors?
There's usually three things, and this is not just financial media, it's media in general. Sure. It's the people who are writing about an industry. They haven't been in the industry in terms of like a actor. That's good at times because they're sober and they kind of are a third party that can evaluate this stuff. It's bad at times because there's just nothing like the education of sitting in the seat of allocating the capital and really understanding it, right? So there's pros and cons, but that's one piece. The second thing is most people are not going to tell journalists what's actually happening until it's already happened. Right? An investor never calls up a journalist and says, hey, watch this, I'm about to buy this stock. Right? What do? They buy the stock and then they tell them, hey, guess what I just bought?
Yep.
Right? So there's a little bit of like, by the structure of the market and the relationship between the market participants and the media, you get the information later because they want you to get it later. And then the third thing is there's a huge difference in media in general of there's experienced journalists have been around a long time. And then there's a lot of media companies that have gone, they've cut an immense amount of cost. What they had to do is hire much younger people. And so experience is experience, right? Even if you're not the person allocating the capital, if you think of your career, right, you're way more experienced today than you were on day one.
Yep.
And so just like that compounds over a career. And so if you have a newsroom full of 22-year-olds, how much can they really, kind of drive versus if you have a newsroom full of 35-year-olds? Now, obviously, you want a newsroom full of a couple of different buckets of people, right? You want to kind of have a well-rounded view of things. But I think that is a huge part that no one talks about is what is the market structure? What is the relationship between the market participants and the media? And then also, who are the people writing the stories and like how have we, whether we are the media or we as the market, educated them? And so I always joke that like one of the best things that we could do in terms of both sides of the market is the journalists go do a day in the life with the investors and vice versa. Do like instead of like a jersey swap, do like a player swap, right? And just like make a financial investor go sit inside of a newsroom. They'd have a whole different appreciation for everything that goes on in there, right? Vice versa is have the media person go sit inside the trading room, right? Or inside of an investment firm. And it's just all of a sudden you get exposed, right? Yeah. You have some nuance and everyone becomes a little bit easier to work together.
It would definitely make for better conversations, I think, long term. Something that I thought was interesting when FTX was collapsing, a lot of the media comparisons were to Enron, but then most of the media members writing about it weren't old enough to have reported on Enron. And sort of what you're saying about this lack of experience and maybe the longevity of a reporter's career. I think we got a ton of very interesting insights from you today, Pomp, and I really appreciate your time.
Thank you so much for doing this. We'll do it again.
Sounds good.